Hello, listeners, and welcome back to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm also a partner and the director of geopolitical analysis at Cognitive Investments. Rob and I are back at it on our weekly chat about markets and geopolitics, and this week, Rob is really the star of the show because this week was about markets, not so much about geopolitics and the news about Silicon Valley Bank and fears that we're headed towards another 2008 moment. Spoiler alert, we're not. I'm here recording from Wisconsin Dells. I spoke at the Professional Dairy Producers of Wisconsin annual business conference yesterday. It was a great time, and if you just discovered me from seeing me at that conference, welcome. Glad to have you as listeners. This episode is a little bit unique because we focus on markets in particular and on Silicon Valley Bank. We also talk a little bit about what it is we do at CI. So I try to make most of this podcast about the content. I don't want to advertise or talk about anything else, but this was a really good example of explaining what we do, because CI is where we manage assets for individuals. It's where people come to us and trust us with their assets, and we help manage those assets for them. Now, I have Perch Perspectives, which is a geopolitical consulting company and works directly with companies to help them think about their supply chains. And I provide bespoke reports or ongoing monitoring or monthly or quarterly webinars with some of my clients to help them figure out what's going on in the geopolitical realm. Rob is also a principal at Off Wall Street, which is a premier short research firm that serves hedge funds and other institutions on Wall Street. So gives them ideas on the short side about companies and forces that are out there. And CI is really where we take that macro geopolitical insight, we take that short on the ground insight over from what's happening at Off Wall Street. We put them together, and those inform the strategies that we create for our individual clients. So in some ways, it's about us not just taking the research and thoughts that we're generating out there, which we do have clients for, but then putting that money to work ourselves. So I just wanted to explain that because we actually don't spend a lot of time explaining what we do here, and the marketing team here thinks that I should. So that's what we do. And when I say at the end of this intro that, hey, reach out to me at jacob@cognitive.investments if you want to talk about any of the things that we do, that's what we do. So if you're an institution and you want access to that kind of financial nitty-gritty research, if knowing about Silicon Valley Bank a year ahead of time is something important to you, write to me and we can hook you up. If you want to know about our geopolitical consulting services, if you are somebody who has interests abroad and you want to have a much better sense of what's going on either in individual countries or parts of the world or how that's going to affect your supply chains and businesses, also email us. That's something we do too. And if you trust us, if you've been listening to us for long enough and you want to talk about how we manage individual client assets and how we put some of this research and these ideas that we talk about in the podcast every week to work for our clients, you can also email me. We can talk about that too. If you're not interested in any of that, you just want to keep listening to the podcast, that's great. That's what it's here for. It's never going anywhere. I'm never going to put ads in it, and I'm never going to put a paywall on it as long as I'm the one calling the shots here. So enough mumbo jumbo. Let's get into the episode. Cheers, and see you out there.
Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.
All right, for the last time for a couple weeks, I'm on the road again. Wisconsin Dells, Wisconsin, the Kalahari Water Park and Resort. I haven't had coffee again because, Rob, you're in Paris and I have to get up early. And I'd rather have the extra hour of sleep than a cup of coffee. So here we are. I hope I don't bite your head off.
I'm sure you'll be your usual charming self.
I'm already off to a good start. I got to say, I go to a lot of different conferences and meetings and things like that. And this Dairy Producers event here in Wisconsin, they've really stepped up the game. They had multiple grilled cheese stations throughout the Hall of Ideas on the floor, multiple types of chocolate milk constantly refreshed all around the place, and unlimited access to ice cream sandwiches. So I'm thinking about insisting for all future events that at least one of those three things is included in all future events, because I'm over here in heaven. But let's not talk about my love of cheese right now. I should probably do a whole other podcast series just on the geopolitics of cheese, and 10 people can listen along with me. Rob, the big news of the week is not geopolitics for once. I feel like I'm not the prettiest girl at the dance. It's you. It's Silicon Valley Bank, and Is it Lehman 2.0? Are European banks going to crash in sympathy with this? Are we headed to another financial crisis? I know some of the answers there, and that's intentionally a little sensationalist. But why don't? And I know that in some ways you've focused so much on this that it bores you in some sense. But let's just rehash very quickly for those who maybe, if you're lucky enough not to have followed this, or you've been living under a rock. A, can I come hang out with you? And B, can you tell them what exactly has happened with Silicon Valley Bank in the last week or so, and what's been spreading to Europe and why fear has been reverberating throughout financial markets?
Sure. So the takeaway before getting into what happened, the TLDR here is this is not that big of a deal. And maybe that's going to be famous last words, but really, this isn't Lehman 2.0. It's not 2008. It's not even the savings and loans crisis from the 1980s. It's much, much more contained. So what happened was Silicon Valley Bank, which is the 16th or was the 16th largest bank in the US and catered primarily to VC firms, startup companies in technology and biotech, that whole area, and was a very, very rapidly growing bank during the tech bubble years, which, in some sense ended about a year ago. They collapsed and they got bailed out. They got taken over by the government and they're seeking a buyer right now. Their depositors have been largely guaranteed by the government, which is a controversial issue to some extent that people are fighting over. But the reason is kind of boring and kind of technical. But in short, it's because the tech sector has been shrinking. They levered their entire business to a very volatile part of the economy. And after the tech bubble burst, a lot of startup companies and VC firms were drawing down their deposits as their businesses shrank and as they didn't replace them with new capital. And this sucking out of the liquidity out of Silicon Valley was sufficiently rapid and strong that Silicon Valley didn't have the assets available that they could sell without essentially triggering themselves into insolvency in order to meet those deposits. So people began to realize this. They got scared. Word got around real quick, especially because everyone who's a customer of the bank, for the most part, they all know each other. Everyone rushed to get out their deposits before it was too late. And so the bank experienced a classic deposit run and had to shut. That's the short version.
I see what you did there in short. There's something here about the psychology of bank runs too. I mean, it reminds me of everybody going to the store at the beginning of COVID and buying, 500 rolls of toilet paper because they thought that the end of the universe was nigh. So, I mean, there must have been some, and I guess we don't know it, but there must have been some psychological tipping point or something that happened where somebody had trouble or somebody called somebody and said, hey, I can't get my money out. Do you know what's going on here? Or heard something bad? Because it's not that, it took that psychological bank run moment to bring Silicon Valley to its knees, right? Like, it's not like it was just out there and, something happened and it sort of slowly happened over time. It happened fairly quickly.
Well, they had been experiencing deposit declines for a few quarters, and they had accelerated in the recent couple of months. So their deposits went from 95 billion down to something in the high 60s, I think it was. So it's a pretty significant drawdown on deposits. And it's sort of a snowball effect where it starts out small as certain people see the deposits are going down and sort of recognize that maybe there's going to be some issues. More and more people begin to withdraw, which makes the deposits decline faster, which causes more people to panic. I mean, it's a self-reinforcing spiral. That's usually how these things work. Just like any financial panic. That's why in order to stop these things, you need government intervention to come in and essentially provide a circuit breaker, provide a huge, foot on the ground to say, okay, now it stops. here is the self-reinforcing factor that's going to push things in the other way. So that's what the government did when they came in and provided the deposit liquidity support above the $250,000 guarantee. So just as a reminder, if you have a bank deposit, you're only guaranteed, it's only insured by the FDIC up to $250,000. But in this case, the government waived that maximum and extended it much higher because of the circumstances. So that helped sort of stabilize the situation, but the bank failed nonetheless, and they're seeking a buyer, and they were taken over by the FDIC, which is what happens when you have a bank failure.
One could argue, if one was an idealist or an ideologue more precisely, that another way to prevent this type of issue from happening is not making it so clear that a bailout would be inevitable. But that's a conversation for whiskeys and probably not for the podcast, but for, political armchair opinions. I want to do, I'm sure a lot of people have heard about Silicon Valley Bank, and we don't want to rehash stuff, and we will get to contagion and Credit Suisse and what's going on in Europe and a bunch of other things. But I think this is a good opportunity for us to take a little bit of a step away from the content and talk a little bit about ourselves, how we're structured, and why this was actually something that was on our radar a long time ago. So most of you know us. We're coming to you from Cognitive Investments. This is Cognitive Dissidence. It's the Cognitive Investments podcast. I also have Purge Perspectives, which works directly with companies, giving them geopolitical insights on supply chains, offering them research, bespoke products, monitoring, things like that. Rob, your other hat that you wear is you're over at Off Wall Street. So, and I think this is an instance where we need to talk about Off Wall Street a little bit, because you guys were talking about Silicon Valley Bank over a year ago and putting out reports over a year ago that were saying, hey, there might be a problem here. So maybe give the listeners just a little bit of a taste, because we really don't talk about Off Wall Street that much in the podcast. Maybe just give the listeners a very short take about what Off Wall Street is and what you're doing over there and how we use both those macro and micro insights to do things at CI. And then tell us, what did you see at Silicon Valley Bank a year ago? Why was Off Wall Street saying, hey, this doesn't look so kosher and people should be watching this? And it turns out you were vindicated in that view.
Yeah, and the background to this is, I promise we're not going to sit here and promote our wares too much, but this is such a extraordinary case. And at the beginning of this, I asked Jacob, well, what do you want to talk about today? And he said, well, are you kidding me? We have to talk about Silicon Valley Bank. And I said, I'm so sick of talking about Silicon Valley Bank, and I'm so sick of hearing about it, because we've been talking and writing about it for a very long time. And So the background to that is, on May 17th, 2022, so almost a year ago, we wrote a report for our clients at Off Wall Street. And at that time, the stock price of Silicon Valley Bank was $448 compared to zero today. And we wrote this analysis pointing out that these guys were going to experience significant problems. And what we said specifically was, quote, investors may be failing to appreciate the negative implications of the current downturn in private markets activity to SIVB's business. They are levered to a deeply cyclical end market, and the cycle appears to be turning. So that's what we wrote, and we had a whole analysis of why these guys were probably going to see their balance sheet shrink and experience all these problems. We did not say, oh, they're going to get taken over by the government, because that's a fairly extreme outcome. But our clients were aware of this and were prepared, and many of them profited from this because we were there well in advance. Okay, so the back padding part of this segment is now over. We nailed this. And just like we nailed Enron and Diamond Foods and the few cases in the past where something really extreme has happened like this, we were there and we saw it and we wrote about it, right? So enough, laudatory stuff. Why does this matter? Why does it matter? Because it's so tiresome to hear all about Silicon Valley Bank this week. And it really brings up something that I've been talking about on the podcast, and something that is really fundamental to what we do at CI and at Off Wall Street, which are really the two Janus faces of the same team. Off Wall Street is the business where we provide research and insights to other money managers. And CI is the business where we take those insights and apply them for clients ourselves. And really, the thing that I've been harping on, and this is a perfect example, is in a world where information is abundant, where information is just coming out of your ears, the value is in what do you pay attention to? How do you find those things, both positive and negative? Because it's not just, the big short. It's also very positive opportunities that are emerging, and no one is paying attention. No one is writing about them. No one cares. How do you, structure an organization? How do you structure a process to consistently see these things before they're all over the Wall Street Journal and the Financial Times and everyone's moralizing and Congress is saying, we should do this, you do that. How do you do that? And that's what we specialize in both places. So, and that's sort of what I would leave people with is if you're listening to this and you're managing money, you're responsible for your own clients, or maybe you're managing a business and you're responsible for, keeping an eye on what's going on in the world and identifying issues that may arise before they arise and preparing your business to deal with them before they're on the, front page of the Wall Street Journal, then I think it behooves you to keep in contact with us and to give us a call or to email us and ask about what we're doing. Because to see all these people just blindsided by something that was fairly obvious if you were just paying attention, it really shows the value of having that kind of insight that we provide.
While you were talking, I went back and looked at the front page of the business section of the New York Times on May 17th, 2022. And besides a couple articles like, "Are you happy your boss is asking?" The main topics of interest seem to be Janet Yellen going abroad to get the global tax deal back on track, some scare stuff about natural gas prices and how Qatar could become a Middle East giant because everybody was going to have an energy crisis coming up. Ha ha. Something about a JetBlue hostile takeover bid for Spirit Airlines and McDonald's announcing that it was going to sell its Russia business. To your point, lots of stuff there, none of it important today. But, you were looking at the Silicon Valley Bank thing at that point. What did you guys see at that moment that tipped you off? Take me through the method that allowed you to say, okay, this was the thing that we wanted to focus on in that moment. Was it really just that broader, hey, like we're in the macro cycle. You and I have been talking about how tech is going to be in a rough place for literally years. And because the Federal Reserve was finally signaling that it was going to hike interest rates, oh, well, that meant that, certain companies or banks that were exposed to the tech sector were going to experience trouble. Was it that simple? Was there something else that was going on? How did you land on that? And what information were you consuming at the time that made you not worry about all those headlines I just said, but had you publishing a report about Silicon Valley Bank?
Well, I would love to be able to tell you a story about, we conducted this intelligence operation and we could see what was going on inside the bank. And, we got tipped off in the back alley by the guy saying, hey, they're really going to have problems. But it's nothing like that. And the reality is kind of plotting and banal, which is that Silicon Valley was a bank that had extraordinary growth because they had bet their bank on this one narrow part of the economy, which is the startup economy, tech, biotech, VCs, right? And as a general rule, like when we look for bank shorts or financial services shorts, historically we look for assets that grow a lot, balance sheets that grow a lot, because it's very hard to grow very, very fast in financial services without doing something stupid. And, these guys were doing something stupid, which was they were taking too much risk on what was inherently a very cyclical and volatile customer base. And that risk looks good on the way up, and they looked really good on the way up, and people believed in them and were extrapolating their growth off, far into the distance. It was going to be from $448 to $1,000, just as things go up and up, because people tend to do that in a linear fashion. And, over and over again, people fail to sort of visualize the downside of that, uh, deeply cyclical industry. And this is something that is a recurring pattern. It happens over and over again. And all you had to do was really analyze their numbers, do a little ground field work, to talk to people in the banking industry, to talk to people in the VC industry who could see what these guys were doing. And they weren't doing something nefarious. This wasn't the subprime bubble. They weren't lending, to people who didn't exist or to projects that didn't exist. They were just taking way too much risk, and they were being complacent. So it didn't require some genius analysis to see what was going on. It just required paying attention and seeing the thing that you should focus on and really spend your time on that everyone else is ignoring. That's the value add.
Yeah, somebody posted on Twitter, and I'm sorry, I don't have it at my fingertips, so I can't give the guy credit. But he got a bunch of front pages of Forbes magazine over the past year or two, or even more than a year or two. But there was a Forbes cover with Elizabeth Holmes at Theranos, and there was a Forbes cover with Sam Bankman-Fried and FTX, and then there was a Forbes cover with Silicon Valley Bank. And I don't know, that was just kind of very striking to me that there has been you can go look on the cover of Forbes magazine to find some of the biggest epic both frauds and economic collapses of the last couple of years. There's maybe a lesson in that too. To your point though, I think this is also where the macro narrative helps. I mean, before I was a partner at CI, when we had barely just met, we had a webinar where we were talking, and you really spearheaded this, where we were talking about, and this was 2020, I think it was July 2020, where we were talking about there's been this huge run up in tech. Maybe there's a little bit more of a runway to go, but fundamentally, this is probably not where growth is going to be going forward. We're more interested in other parts of the economy. And it's interesting because that's now starting to be in the mainstream. I saw Cousin Marco out there declaring tech is dead, at a conference last week. That narrative's already out there. Not to throw shade at Cousin Marco. 2 years ago, we were saying that not the tech was dead, but hey, this tech situation doesn't look so good. Which I think is also a good way to pivot to, because there's a lot of schadenfreude out there right now about Silicon Valley Bank. And I get it. I don't have any schadenfreude about this, but I still can't get enough Sam Bankman-Fried content. I just love sitting there wallowing in the schadenfreude of Sam Bankman-Fried. But let's not do that, and sort of tell me, or let's talk about what people should be looking at now, because it's easy to rehash everything in the past. And if you want, the 3-part podcast with 3-hour episodes of what went on at Silicon Valley Bank, I'm sure somebody out there is going to make that content and it's going to do great. But what are we looking at today? What are some of the things that we think people should be looking at that they're not looking at, and in 2 years will make headlines like this?
Yeah, because if you're spending your time this week wallowing in all the Silicon Valley Bank coverage, what are you doing for yourself? You're not adding any value for your business or for your investment firm, or whoever may be listening. You should be spending your time researching the thing that no one is talking about, right? So here's an example, because it's so easy to come on the podcast and say, well, we nailed this, and here's what happened, and here's what we saw. All the signs were there, Jacob. Let me tell you, of course, all the back padding and all this stuff you're hearing from everyone else who claims that they knew it all along, right?
And just a reminder to listeners, we come on and explain when we're wrong all the time too. We had a bet on Russian equities because I thought Russia wasn't going to invade Ukraine. Now I'm proud that we got out of that before the Russians closed the stock market, because we were watching and we were thesis is wrong, but we're not always right. But so I think the listeners know that.
Yeah. And again, it's not just negative things, it's positive things too, because the big opportunities are the things like Bitcoin was once something that no one paid any attention to, and you can argue whether Bitcoin is positive or negative, but clearly that became a social phenomenon over some period of time. And there was a time when you could have learned everything you wanted about Bitcoin. There was no lack of information. It's just, what do you pay attention to, right? So, on the negative side, here's something that no one is talking about that we wrote about a few months ago. That I don't know if this will be in the news, but we've prepared ourselves and our clients at Off Wall Street and at CI for the scenario in which this does happen, and that is the issue of air traffic over the Black Sea. And this is actually kind of timely because lost in the shuffle here, there was a collision between a U.S. fighter jet and a Russian drone, or was it the other way around?
Nope, you got it.
I'm screwing that up. Over the Black Sea this week.
You're right. It was a U.S. drone, Russian fighter jet.
Yeah, U.S. drone. Yeah, that's what I thought. So what's the story with that? So what people don't realize, in short, is that the entire airspace over Ukraine and Russia has essentially been shut down to almost all global aircraft carriers, with the exception of like some of the Chinese carriers and countries that have good relations with Russia or relatively good relations with Russia. And that hasn't been a huge problem because all the traffic is being diverted over the Black Sea. The amount of traffic going over Azerbaijan, for example, is up 120% from where it was pre-pandemic. And if you go to a place like Baku, right? So we've been learning a lot about the Baku air traffic control technology. And they're struggling. They're struggling to manage the sheer amount of planes that are flying over their airspace, because everything that would have previously gone over Ukraine, gone over Russia to go from Asia to Europe is now being squeezed through this tight little pipe over Baku and the Black Sea. So, as I mentioned, until recently, that hasn't really been a huge issue. It's been very congested, but it's been manageable. But now things are getting put to the test because China is reopening. So there's two issues there. The first is the passenger traffic. So China had a significant amount of passenger traffic that was going from Hong Kong, Shanghai, hubs like that to Europe. And let me tell you, the Chinese tourists are back in full force in places like Paris. To see them emerging now for the first time in a long time. And the volume of planes getting squeezed through that little choke point is now increasing even further. The other issue is that air freight. So air freight comes in two types. There's dedicated freighters, so planes that just carry cargo, and that's about 50% of all the air cargo that gets shipped around is in a dedicated freighter. The other 50% is in passenger airplanes, where they put cargo in the belly of the plane, so it kind of does double duty. So now you're seeing air freight volumes increase again after being, at a cyclical low. We've talked about the inventory cycle in the U.S. and how that was really depressed, and how the ships aren't even bothering to go to China, et cetera, et cetera. Well, all those Chinese factories that are making stuff, a lot of that stuff gets shipped in airplanes. So last week we talked about the China PMI exploding and rebounding as China gets up off the mat and the economy gets going in a major way again. That's further increasing the congestion through this tiny Baku choke point. So what happens? Maybe nothing. But if there's any sort of breakdown in traffic, if there's any sort of issue, if there's any sort of Russian incursion into this airspace because of what's going on right next door, I mean, it's literally right next door to an active war. That's a whole lot of the global freight economy that's dependent on a very, very small geographic space. So maybe that will never turn into something, but it's sufficiently high risk that people should be preparing for it and thinking about it and coming up with contingency plans and thinking about, well, what kind of assets get affected positively and negatively if something should happen there. All these things. That's what you should be paying attention to, things like that. Because the Silicon Valley thing, everyone's all over that now. That's done. So what are all the other hidden things?
Yeah, no, the Silicon Valley Bank thing is history. I mean, and this is where this is where this point broadens beyond markets, and you could apply it to geopolitics or just about anything you want. I mean, two great examples of this that, I mean, I'm here at a dairy producers conference. They export a lot of their milk to China. They're seeing all these headlines about, oh, China's going to invade Taiwan. I keep on getting bunches of questions about that. But you know where actually most of the milk that the U.S. exports goes to? I mean, China's a big market for it, but it's Mexico. And when I get on stage and I start talking about, not about cartels and kidnappings and drug this and this person got kidnapped, but I start talking about, hey, here's what President AMLO did last week. Here's what it means for the Mexican government to be attacking the institutions that protect democracy in the Mexican state. That could mean good things. It could mean bad things in general. But your most important customer, who's right across the border from you, you probably aren't paying that much attention to Mexico unless you're laser focused in it. I was right. I asked in the room, raise your hand if this is something that you've heard about. And there wasn't a hand that was raised in the room. It was all about, oh, I thought that China was going to invade Taiwan. And that was the biggest risk that I had to sort of look into. So across the spectrum, there is that kind of, I don't know, that all of that clutter that you sort of have to sort through. What's a positive example? I know that, at an innovation level, we sort of telegraph some of the things we're looking at by the kind of guests that we have. Like we had Miles on the podcast, that nuclear fusion podcast. That's as much a podcast for you listeners as it is a reference point for me to go back and say that was the beginning of my nuclear fusion research. And I took homework, 10 different questions I have to research, and I'll bring back Miles on when I've actually done the research. What's an example of a positive one that you're thinking about right now, or something that you're thinking about that's going to be an opportunity rather than a downside?
Yeah, and as you mentioned, we have been really digging in and researching and studying a lot of areas of innovation in anticipation of launching a big new strategy for our clients and really making this much more front and center in what we do. And we'll have an opportunity to speak about that a whole lot more in the coming months. But along the vein, so what is something in the innovation theme that no one is paying attention to, that we're finding very interesting and reading about and studying? And that is the potential for hidden assets in the defunct coal-fired generation facilities of U.S. utilities that no one likes. So what do I mean by that? If you look at a company like Dominion Energy is a kind of crappy utility. Most of their businesses in Virginia and West Virginia, sort of the mid-Atlantic states, they have a lot of coal-fired capacity. They're in coal country, of course. A lot of that is not running at high utilization, or it's actively just mothballed. So they have a whole, kind of host of problems, and no one really likes them, and not too many people care about them, and not too many people care about this area in general. The interesting aspect of this story that no one is really seeming to talk about is there seems to be a growing consensus in the fusion and sort of nuclear fission generation community that these coal assets, these coal plants that are either running at very low capacity or they're shut down, are hugely valuable, because you can take these small modular reactors that they're developing, including the new fusion ones. So some of the very early stage fusion companies, they've already done this on the West Coast, where they've launched prototype reactors. They've located them in disused coal facilities. And why are they doing that? Well, because the coal facility has all of the interconnect in place to the existing grid. It has all the permitting. It has the workforce right there. All of the stuff that you need and that is so expensive to build, they've already got it. And it's being valued at essentially nothing in relation to the utility businesses. So if you think fusion has a future, if you think that there's the opportunity to use nuclear as part of a broader mix, where are you going to build these facilities? In all likelihood, you're going to take advantage of the space that's already provided and slot them in. And in the case of Dominion, it's particularly relevant because some of the biggest growing energy consumers in the mid-Atlantic, especially around Virginia, are data centers, because that's one of the, if not the largest area for data center construction in the US. And all of those guys have committed to using renewable or zero carbon energy to power their facilities. So where are they going to get it? That's the opportunity. So I don't know if that.
No, it's perfect. And I think it perfectly underscores your point, because this is not some top secret thing. It's not like you dressed up in a tuxedo and you were wandering around West Virginia bars and you found out from the coal miner who lost his job, they have these idled coal factory. I think that, I know somebody who's going to put a nuclear fusion reactor here, or put some kind of solar panel or wind thing here. You can find this in the newspaper. It's usually, I think the Wall Street Journal had a story about this a couple weeks ago. It was something like page 8. That might not actually mean anything to Gen Zers. Gen Z, you used to have to open up a paper newspaper and flip to different pages. So the metaphor is that you would have had to get about 8 pages into the business section of the Wall Street Journal to get this tiny little story about, there are these coal companies and utility companies in the mid-Atlantic that maybe they're going to do this thing with data centers and it might give them a new life. So again, it's not about top secret stuff, but it's about getting through all the fluff that's on the front page and getting to the stuff that's actually interesting. I want to zoom out a little bit, and I think I know the answer to this question, Rob, but it does look like the Silicon Valley Bank thing has gone beyond Silicon Valley Bank, although I don't know how much of a link to draw between Silicon Valley Bank and what's happening at Credit Suisse and what's happening with some of the European banks in general. I think what you're going to tell me is that, we've talked about how the ECB was behind the Federal Reserve and hiking rates because of the Russia-Ukraine war. Now they're starting to hike rates, just as in the United States, as the macro environment changes and it put pressure on Silicon Valley Bank. If you're a bank like Credit Suisse and you've been circling the toilet bowl for literally years already, if you're starting to get this pressure and compressed growth and all these other things in Europe, it's putting pressure there, but it's not this kind of systemic financial risk in the European sector. As we look at what's happening in European markets, because they seem to have caught a cold from our panic here in the United States, do you see anything concerning? Do you think it's part of the story? Do you think it's a completely separate story? How are you seeing what's happening in Europe?
Yeah, well, I think you have to connect what's happening in Europe to what's happening in the US. So let's get into the banking situation and get back into the particulars and what is the situation and what does it mean for, policy and economies, right? So the closest corollary to today is 1994, which most people don't really remember. People remember 2008. They remember there was a huge tech bubble. They remember maybe the savings and loan crisis in the 1980s, which most people remember existed, but they don't remember what it was exactly. No one really remembers 1994. And that's partly my point, is this is not a Lehman moment. This is a very particular issue that's arisen, and it's much less nefarious. So the issue here is primarily around liquidity. The difference between now and 2008 or previous credit crises, banking crises, is banking crises usually emerge when people operate with a certain set of assumptions, and then all of a sudden one day they wake up and they say, oh shit, that's not what I thought it was. And there's an enormous amount of uncertainty all of a sudden. Uncertainty is what kills in banking crises. So if you think of Lehman Brothers for a moment, the whole financial system, the whole banking system was operating on the assumption that mortgage-backed paper was of the highest quality, that it was not going to default, that it was AAA. And then one day people woke up and said, oh shit, that's not true at all. And you have to reevaluate everything that you're doing. It's like, being married to someone for 30 years and you wake up one day and they're like a crocodile and you just, wow, you have to change some of your plans, right? Um,
Maybe that's what happened to
so
Bolsonaro. Maybe his paramour turned into a crocodile after taking the vaccine. I should be more
I
sensitive.
was, as soon as I said that, I was thinking of Bolsonaro. That's funny. Um, so that's the difference, and the difference between that sort of environment and this sort of environment is that's not the case at all. This is not a credit problem. There's not uncertainty about the quality of assets in the banking system, which is the most nefarious kind of difficult banking issue to deal with. The issue here is that um, just like in 1994, so in 1994, just to put the historical context around this, in 1994, we were coming out of the savings and loan crisis, the very sharp recession that we experienced in 89 and 90. We were coming out of that period, and Alan Greenspan started raising rates very aggressively because the economy was really ripping out of there. And what had happened was, by raising rates so aggressively, bond markets sold off viciously. And a lot of banks and bond funds that were holding these bonds started experiencing significant losses on a mark to market basis. And that's basically what we've seen today. Interest rates have been jacked up very aggressively for reasons that we've talked about and everyone knows. And as a result, banks that are holding a lot of bonds have suffered mark to market losses on those portfolios. And I say mark to market because bonds are not like stocks. Bonds, if the issuer doesn't default, as long as you hold the bond until it matures, you get your money back. So when you say mark to market, it means that the bonds are trading below par, below 100% of face value now. So if you tried to sell them today, you wouldn't get all your money back. And that's a problem for banks. But if you hold on to them, you're fine. So the banks are not fundamentally insolvent. What they're facing is a mark to market problem. And there's a whole bunch of accounting stuff about how they classify certain things and how they have to show them, which we won't get into because bore the listeners to tears, and I'm sure you can read about it elsewhere if you're interested. But that's the fundamental problem: is they own a lot of bonds because they're banks. That's a big part of what they do. The value of bonds has gone down a lot because interest rates are getting hiked. Fundamentally, it's not a major problem. The reason why, like someone like Credit Suisse is running into problems is because they were already weak. They were experiencing significant problems already, and they are experiencing deposit withdrawals, not because they were tied to the VC sector or startups, but really just because they suck and they've been so bad for so long that they've had this bleed of withdrawals that's gotten worse as things have gotten progressively worse for them. So you have these sort of idiosyncratic cases emerging, but this is not a case where the whole banking system is in danger, where the whole liquidity situation is in peril. That's not really the case at all. And in fact, the big banks are getting a lot of deposits now. So without going on and on, that's essentially the situation from a banking standpoint.
Well, that's a shout out to Charlie if he's listening, because he called me yesterday with Mark and was asking me, is this a Lehman 2.0 moment? And he said, it was actually hard for me to hear him because my service was terrible at the time. But he said, is this the end of regional banks? Is this the end of smaller banks? We're all just going to have to go to bigger banks because this kind of environment is just going to kill what's left of these smaller regional banks because they're going to be the ones that take this on the chin the most. Do you think that's an outcome here where we get consolidation in these big banks, which is is that healthy for the economy? Is that something you would worry about?
I think a lot depends on how the regulatory environment evolves. But I think there's a strong desire for that not to happen on the part of regulators in the first place. And in the second place, banking is a commodity, but it's not totally a commodity. So if banking were a pure commodity, we'd all be banking with JP Morgan and call it a day. Because, whatever, we want our money, we want it quick and easy. That's all we care about. But if you look at a company like First Republic or Silicon Valley, which ironically are two that ran into problems, they built franchises by focusing on servicing a specific type of customer. They found a niche, a different way of doing things, which in Silicon Valley's case was not a great outcome. But it's possible to differentiate based on that. So I don't think small or regional banks are necessarily going away, even though the current environment right now is going to help the Goldmans, the JP Morgans, the Bank of Americas, if only because they're scooping up some of the flighty deposits that are currently worried and asking these kinds of questions.
Yeah. Before we get out of here, because I have to catch a plane, as a rule, I don't read much hate mail. And if people come at me on Twitter and I think they're stupid, I usually just mute them. If I respond to you with like multiple GIFs in a row that are making fun of you, by the way, that means I'm not taking you seriously, if any of you haven't quite figured that out yet. But we did have some hate mail last week that you informed me about, which was that somebody heard us talking about wheat and soy and said, who are these guys? They think that ag traders don't know all these things about wheat and soy that they think that they've just discovered. There's no way that they're going to be able to trade this in any kind of meaningful way. And we wanted to close off on this because it relates to that point about, what are you paying attention to and how can you apply that in general? Because our point to Mr. Haterade, who was saying that, is, yes, we do think we can spend a couple weeks getting really, really smart on something, and we can generate insights that actually lead to actionable strategies. And again, I can use geopolitical examples here too. You know who were the last people in the room to realize that the Soviet Union was collapsing in the late 80s, early 90s? It was the experts on the Soviet Union and U.S. intelligence agencies, because they were so focused on very small, very granular things that they couldn't see the forest for the trees. Now, I'm not knocking expertise, and we have experts in our network, and everything that we're doing here, we're going and talking to experts and saying, hey, is this lunacy? Is this crazy? Can you give me a gut check here? What is this from your point of view? But in general, part of our entire strategy here, as geopolitical analysts, as financial analysts, as people who are managing money, is that if you can understand the thing that happens in China and how it connects to the thing that happens in Brazil, and then how that relates to the West Virginia coal miner, that's where real opportunity is. And nobody's an expert in that. It's about having enough expertise and paying enough attention to things that are going on around the world and saying, you know what, I think if I do a little bit more on that, I think I have a perspective here that maybe the people that are in the moment quite aren't getting it. And as I said earlier, we get plenty of things wrong. We also get some things right. We'll see, the proof will be sort of over time how performance dictates it. But I wanted to riff a little bit on that and also let you get back on your soapbox, because you were the guy who read the hate mail. I think it bothered you a little bit.
I wouldn't say bothered, but I think it reinforces one of our core precepts, which is we're generalists. And the value of being a generalist in a world where information is abundant is going up and up and up. And we've seen this. I'm not just speculating. You see this every day. For example, we talk about deciding and determining what do you pay attention to. George Soros used to call this going for the jugular, because George Soros, arguably the most successful, financial trader in the history of the world, he was not a specialist in anything in particular. He would employ some specialists or go and talk to specialists, but he famously said, I have 48 hours to learn everything I can about something as soon as I determine that it's the important thing to learn about. And he would call that going for the jugular. So that's what generalists do. And I think the value of that is getting proved out over and over again. So, in this case, wheat and soy, yeah, I think in 2 weeks you can make a better judgment about that than someone who's, in the field counting each, stalk of wheat and deep in it. Because
or whose livelihood is based on that wheat. Like if you're a farmer or if you're somebody who's actually growing the wheat, like it gets personal in a way that it's not if you're just out here looking at the fundamentals.
Yeah. I think over and over again, you see examples showing that people who are siloed specialists make poor judgments about the subject of their specialty. So you mentioned the Soviet Union specialists in the late 80s. That's a classic example. Just look at Silicon Valley Bank. So as I said, at Off Wall Street, we were writing about this for our clients over a year ago. And as I said, it wasn't some brilliant analysis. You didn't have to be some, grandmaster chess genius to put the numbers together and figure it all out. You just sort of needed some common sense and the ability to understand how banking works and how to model it out. We're not banking experts, we're generalists. The banking experts are the Wall Street analysts who covered the stock and said nothing and realized nothing. Even, I find this very funny. Most of the analysts had buy ratings on the stock for their clients. And even on the last day, as Silicon Valley was going down the tubes and going down to zero, one of the analysts reduced his recommendation from buy to hold. So, really a lot of foresight and bravery with that kind of call.
It probably took a lot of courage to break from the buy pack and say, I don't know about this.
But yeah, no, that's the point here.
No, and the reason I wanted to bring it up was because I don't care about the hater. What I care about is I do think, especially in the American Academy, but in general with American education, there is such emphasis on specialization, and I don't want to demonize that. Like, it's important to specialize on things. And if you're like Miles or somebody else and you are passionate about, nuclear fusion and you want to spend your life understanding this small thing as much as you possibly can, that's great. That's how scientific progress happens. And we wouldn't have scientific progress if we didn't have people who are willing to spend their time knowing everything about this really small thing and handing off to a baton of future scientists or, future philosophers or this, that, or the other thing. I think there's also a place, though, for deep generalists. And I don't like the way that because, we put so much emphasis on specialization on small things, we almost shame generalists. This is definitely true in the academy, and one of the reasons I left academia, because if someone would ask you your interests, or at least I'll speak from my personal experience, when somebody asked me my interests when I was getting my master's degree and I was thinking about staying for a DPhil at Oxford, I'd say, well, I'm kind of interested in this, but I also like this, and maybe I could work this thing into it. And, I'd get looked at askance. They'd be like, that doesn't work. You have to focus on something really, really particular because that's the only way that you're going to produce scholarship going forward. And I don't think it's right to shame. I think that there is room for specialization and there is room for deep generalists. And the only time you go off the rails is if you say the other side is wrong. So I agree with the guy who sent in the hate mail. Like, we're not experts, and you can be sure that I talked to at least 4 different experts to gut check my theory before I came on the podcast and risked embarrassment for myself and for the company talking about it. Like, it's not just I'm out here shooting the breeze. What I don't like is the rejoinder that, you can only do it this one way. Only the specialist can say something about this. Only the person with personal experience can actually know this. That's false. And that's actually a way, I think, to lose knowledge and to lose the sort of trajectory of where things are going in general, because we need both. We need macro and we need micro. We need forest and we need trees. We need all of it working together. That, I think, is the only really way, whether it's geopolitical analysis or making your own life decisions, you have to have interplay between both of those things. If you're too overly weighted in one direction, things will get bad.
And just to conclude with a shameless plug, I think the events of the past week have shown the value of wide-ranging generalism to see things when others don't and before they do. And we've been doing this on the Off Wall Street side of our business for 30 years, very successfully, over and over again. And now we're doing this on the CI business in a different way for different clients. But if you are managing money, if you're in charge of capital, if you have clients that you need to take care of, whether they're investment clients or whether they're the managers of a business, come talk to us, because you shouldn't have been caught flat-footed by this week's events. Email Jacob, give us a call.
On that shameless note, we will see y'all next week. I got to go hop a plane and find some coffee desperately. So see you out there.
Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.